HCL Tech has released its numbers and they are not as per the expectations and they are way below the expectations. If we talk about the revenue in INR terms, it is almost flat, that is 0.3% up. If we talk about EBIT, it is around minus 9.2% down. If we talk about profit after tax, it is around minus 10.8% down. And if we talk about EBIT margin, it is around 171 basis points down. Our expectations were around 30340 in the INR terms for revenue. For EBIT, it was around 5255. For EBIT margin, it was around 17.3%, and for profit after tax, it was around 4,224 crore. But all are all the numbers are down below estimates. So yeah, all in all, it's a relatively bad result as we expected, and let's see how the share will perform.
Right. Thanks for that roundup, Pulkit. Sandip, I want to come to you here first, taking your first few thoughts on the numbers that have come in. A disappointing show from HCL Tech.
Yeah, so while on the revenue front it is broadly in line, but the margins are a miss, and the worst part is that the margin guidance has been reduced by 100 basis points on a thin margin business. So I'm really surprised with the margin being coming down, and also the order book TCV, if you see, down 39% year over year and 8% quarter on quarter, is also a big miss. So I think there is a pressure in the industry, as we have been saying for quite some time now. We believe that this large companies have matured to the extent that you won't see more than 6-7% growth over a longer period horizon, with some pressure on margin because of consistent wage hike and scarcity of a skill set. So this industry has now become very matured, and because of this, you are seeing this kind of pressure. I believe these are poor set of number, and there will be, the sentiments will be negative about it.
What would you say are the major drivers behind this? What do you think?
So I think, products business has declined by 7%, which is a sharper decline than anticipated. And I think that pressure is showing up in the margins as well. And that may be one of the reasons, because IT services was broadly in line in terms of number, but product decline is sharper, and that decline has led to this miss on margin and a guidance going down on the margin front. So I think, there are two things which are happening in the industry. One, this generative AI and agentic AI both are replacing some of the high amount of efforts which were there earlier, and that is leading to lower number of efforts, and lower efforts means lower demand. So you have to compromise on the billing rates, or you have to compromise on the total billings which you are doing. So because of that, it is showing up in the growth, and you cannot immediately streamline the workforce. That shows up in the margin. So if you see, the attrition number has actually fallen to 12.8, which is very low. So it also reflects that there is a lower growth or lower demand in the industry for manpower. So that is the reason there is a guidance cut on the margins as well.
And what does this signify for the other IT companies, their results coming up? Does this signal towards a poor show across the IT pack in the first quarter?
Yes, so the large companies will mostly give a poor set of numbers, except for one or two companies which have some exposure to telecom, and few verticals which have not done well for last 3-4 years, and they have started some revival. So barring those companies where there is some exposure to telecom and there is a leadership change, there could be some delta. Otherwise, I think the large caps at this kind of multiple cannot surprise positively. It is very hard for them to surprise. Even the mid caps, those are trading at 4-5 times PEG ratio, are really, really expensive, and I don't know how long they can be so expensive and how much they can surprise. So I believe the sector is ripe for a huge time correction, if not price correction.
Going forward for the next couple of quarters, do you think a similar performance will follow through, or are we looking at some sort of betterment in the results in the next coming quarter?
So, the challenge is that Indian IT services is primarily first half driven, because second half you have December quarter, which has furloughs, and the last quarter has lower number of working days in February. So because of that, you generally are not a second half driven industry itself for India. So when you are first half driven and first quarter is already showing signs of weakness, second quarter, there are no commentary which suggests that there will be quick recovery. So having said, so FY26 seems to be washed out, honestly. Will be very tough for anyone to do better numbers than FY25, and even if better number, it will be very minuscule outperformance. So given that scenario, I think the stocks have run up quite a bit in last few months before they started correcting. So I think time correction is the least. Only saving grace is that, some of the investors have started thinking of it being the new FMCG where, you are getting similar growth and output with 40% discounted multiple to FMCG, and that is some rationale which people are assigning to buy. Other than that, fundamentally, this is a mature sector. The growth will be very, very difficult and very, very bottom up. Some companies will be able to grow, not all.
And what are some things that you will be looking at in the management commentary, things that we should, be mindful of watching out for?
So manpower is very important because that gives you a direction where the industry is moving. Second, how many people they have been able to train on the newer technologies, what kind of deployment is there, the order book breakdown, how much is coming from the new technology. If those data are fulfilling and promising, then, obviously things could be different. But as of now, based on what data we have in hand, it looks a little tough.
In terms of guidance that has been given for the year ahead with this quarter 1 performance, do you think that some adjustments will have to be made for the entire financial year 26?
So I missed. I did not get your question completely. Can you please repeat?
I'm saying in terms of guidance for the entire financial year 26, with the first quarter being a poorer show, does it mean that some adjustments will have to be made for the entire financial year's guidance as well?
Yeah, so already, they have narrowed down it to 3 to 5 versus 2 to 5 earlier. So, the range of 2 to 5 was quite broader. Now with 3 to 5, the range has been brought down a little bit. But I think, it also implies that you can see it in a way that earlier people may be confident of making 4-5%, and now it could be even 3 or 4. So that is another way to look at. So very hard to comment on that, but I think, weaker first quarter, second quarter is definitely riskier for the whole industry because, as I said, second half, you don't have much to cheer about. So if first half itself is disappointing, second half generally cannot make up for that. So I think, guidance for the whole industry will be little narrower than what could have been anticipated earlier.
Right. And finally, I want to understand about the new deal wins. Now, that is at $1.81 billion. Now, help me understand in terms of, the industry benchmarks, what does this number signify? And is that also a number that we expect it to be much better, and so a lower number, what does that signify?
Yeah, so this number is definitely lower because it has fallen sharply both year over year and quarter on quarter. We expected, at least expectation was not such poor number. So definitely there will be pressure because of this as well. And we need to see more companies are coming. We will see whether this is a read across for one company or it is for the sector. But as of now, the feedback which are coming looks like industry is going through a rough patch.
Right. And finally, if you could just, summarize all of this for us, Q1 for HCL Tech, give us a couple of words to just describe what this means for the company and again for the entire IT pack.
So revenue is in line to slightly weak. Same thing which we in case of TCS, the revenue was even more weak. It was below estimate. Margins, while TCS was able to hold on to some extent, HCL Tech has not been able to hold on to margins. So for HCL Tech, it is a inline kind of revenue numbers, but weaker margins and guidance being brought down. So looks like some more volumes may come, but they will not come at the company specific margin. So till now, whatever results we have, it is a mixed bag. One company has given a poor show on the growth, another one is given a poor show on the margin. So not much to conclude. But order booking and everything are looking slightly below what it should be.
Thank you so much, Sandip, for joining us on the show and giving us that perspective and those insights. Thank you once again. Right, so a poor show from HCL Tech coming in for the first quarter, misses on many fronts. Only revenue is the one that is in line.